January 30th, 2026. The precious metals market experienced its worst crash in over 40 years. Gold plummeted 9.8%, silver collapsed 31%, what traders call the February massacre. Retail investors watched billions evaporate. Social media erupted in panic. ETFs saw record outflows. The consensus? The bull market was dead. But 72 hours later, JP Morgan did something stunning. They raised their gold target to $6,300 per ounce, a 33% increase from crash levels. While retail dumped in fear, the world's most sophisticated banks positioned to buy. This is the story of the great divergence. Understanding why could mean the difference between catastrophic losses and generational gains. January 26. Gold hits $5,600, silver reaches $121, levels unseen since the Hunt brothers' 1980 squeeze. Year to date, gold up 66%, silver up 269%. Retail euphoria peaked. Moon predictions everywhere. The narrative, dollar collapse, runaway inflation, precious metals as the only safe haven. January 30th changed everything. Trump nominated Kevin Warsh for Fed chair, a known inflation hawk favoring higher rates. Markets had priced in 6 rate cuts. That died instantly. Gold plunged $380 in 28 minutes. Final damage, down 600 to 47.45. Silver, minus 31%. ProShares Ultra Silver lost 62% in one session. Mining stocks obliterated. Technical factors amplified carnage. CME raised margin requirements to 15%. Leveraged traders got margin calls. Forced liquidation triggered stop losses. Algorithmic selling piled on. By Monday, February 2nd, gold tested 4,400. Silver hit 71 before stabilizing mid-80s. Retail went from euphoria to panic. The universal sentiment, escape before total collapse. While retail experienced peak fear, institutions did something radically different. They got more bullish. February 2nd, the exact same day, silver extended losses and gold tested new support levels. JP Morgan released their bombshell research note. Gold targets $6,300 by year-end 2026. Remember, they're publishing this from $4,700 levels, where retail was in full panic selling mode. They called for 33% upside from the depths of the crash. And JP Morgan wasn't operating in isolation. Deutsche Bank immediately reiterated its $6,000 gold forecast. Goldman Sachs stood firm at $5,400. Morgan Stanley maintained its bull case target of $5,700 for the second half of 2026. These aren't small regional banks making speculative calls to generate trading commissions. These are the absolute titans of global finance, institutions that collectively manage trillions upon trillions in assets and employ armies of PhD economists, commodity strategists, and market analysts. So the question becomes unavoidable. What exactly do they see that retail investors don't? JP Morgan strategist Nikolaos Panagiotis wrote, "Even with recent volatility, we remain firmly bullish on gold over the medium term based on a clean, structural diversification trend amid a well-entrenched regime of real asset outperformance versus paper assets." Translation: 3 critical factors. First, the diversification trend. Private investors currently hold 3% in gold. JP Morgan models show if that rises to just 4.6%, incremental demand drives gold to $8,000 to $8,500. Not a typo. 8,000. Their base case is 6,300, but modeling 8,000 plus scenarios signals a fundamental mindset shift. Second, regime of real assets over paper. The 40-year Great Moderation era. Low inflation, stable growth, predictable policy is over. We're now in massive debts, persistent inflation, geopolitical fragmentation, lost central bank credibility. Paper assets carry counterparty risk. Gold doesn't. It's nobody's liability. Third, central bank demand, the structural pillar. JP Morgan forecasts 800 tons of central bank gold purchases in 2026. That represents roughly 1/4 of total annual mine production globally. Let that sink in. Central banks alone will absorb 25% of newly mined gold. But this isn't mere speculation or hopeful forecasting. This is based on hard data and observable trends already in motion. According to World Gold Council comprehensive tracking, central banks have been net buyers of gold every single year since the global financial crisis of 2008. That's 18 consecutive years of steady accumulation. In 2025 alone, the official sector purchased 863 tons. Poland's National Bank led the charge, adding 102 tons to reserves. Kazakhstan bought 49 tons. The People's Bank of China has been methodically adding to reserves month after month, even as gold traded at record high prices that would typically discourage price-sensitive buyers. But here's the profound question that separates institutional thinking from retail thinking. Why are ultra-conservative central banks, whose entire mandate is to be risk-averse and protect national wealth, buying gold at what retail investors perceive as expensive levels. Why aren't they waiting for a pullback? Because they're not thinking in terms of weeks, months, or even years. They're thinking in terms of decades and fundamental geopolitical realignment. They're positioning for a world that looks structurally different from the one we've known. Consider China's recent strategic move to offer gold custody and storage services to foreign sovereign wealth funds and central banks. This isn't simply about buying more gold for China's own reserves. This is about constructing an alternative architecture to the dollar-dominated Western financial system. It's about creating the infrastructure for what analysts call de-dollarization, the gradual shift away from dollar hegemony toward a multipolar currency system. Poland, Hungary, and other Central European nations haven't just been buying gold, they've been physically repatriating it. That means literally moving gold bars from vaults in London and New York back to home country storage facilities. Why go through the expense and logistics of moving physical metal? Because in a world where financial sanctions and asset freezes have become routine tools of foreign policy and geopolitical pressure, physical possession in your own sovereign territory matters enormously. Gold in a London vault might be subject to British legal jurisdiction. Gold in a Warsaw vault is under Polish control. That's not paranoia. That's strategic thinking informed by recent history of sanctions regimes. Fourth, interest rates, but not how most think. Yes, Warsh suggested higher for longer, but structural pressures favor eventual cuts. U.S. debt, $38 trillion. Annual interest, approaching $1 trillion. Eventually, the Fed must cut to prevent debt spiral. Here's the kicker. Gold rallied, despite high real yields in 2025. Traditional inverse correlation broke. Gold trades on different drivers now. Geopolitical risk, currency fears, fiat system confidence loss. This is regime change. While institutions bought, retail did the opposite. Understanding why reveals investing's most costly mistakes. The data. Week after crash, retail silver ETFs saw outflows over 100 tons. iShares, Silver Trust, worst redemption since COVID, March 2020. Australian platform CommSec, 3 million customers, massive sell spike. The pattern, retail buys high, sells low, chases momentum up, panics down. Psychology. Many watched silver go $28 to $120, 400% gains, social media millionaire stories, everyone wanted in. But late entrants didn't understand fundamentals. They weren't buying for supply deficits or industrial demand. They bought because price went up. Pure momentum. When crash came, no fundamental anchor, just price charts going wrong. Without understanding, fear dominates. Retail crash psychology, denial. Healthy correction will bounce. Fear. What if it keeps falling? Capitulation. Get out before losing everything. Institutions ask different questions. Has fundamental thesis changed? Are central banks still buying? Supply deficits intact? Geopolitics still supportive? If yes, crashes become buying opportunities, not panic triggers. Time horizon difference. Retail thinks days, weeks, months. Checking phones constantly. 10% pullback feels catastrophic. Institutions think quarters, years, decades, building multi-year positions. 20% correction in secular bull? That's noise. That's better entry prices. This creates emotional arbitrage. Retail panic sells during crashes. Institutions buy discounted. When markets recover and retail chases momentum, institutions distribute at premium. Wealth transfer mechanism, every cycle. Leverage amplifies pain. Many retail traders use leveraged ETFs or futures. 3-to-1 or 10-to-1 leverage means 10% against you wipes you out. CME margin increases forced liquidations unrelated to fundamental views. Institutions rarely use extreme leverage on long positions. Capital base weathers volatility. Structural advantage. Buy when retail is forced to sell. Information asymmetry. Retail gets info from social media, news networks, forums. Backward-looking, reactive, emotional. Institutions have research teams, company management access, central bank relationships, proprietary data, not reacting to headlines, building complex models, stress testing scenarios. JP Morgan's 6,300 target days after crash wasn't emotional. It was extensive research analyzing central bank behavior, ETF flows, mine supply, macro scenarios. Retail saw crash and ran. Institutions saw correction and ongoing bull and prepared to add. This essential difference explains why retail underperforms while institutions capture long-term gains. Silver is where the story gets extraordinary. Unlike gold, primarily monetary, silver has split personality. More volatile, potentially more explosive. Supply deficit story. Silver Institute data shows 5 consecutive deficit years, 2021 through 2025 cumulative shortfall, 820 million ounces. Every year, demand exceeded newly mined supply plus recycling. Gap filled by drawing above ground inventories, exchange warehouses, bank vaults, private stockpiles. 2026 deficit projection, 200 million ounces. 1/6 of total annual supply. Critical point, inventories running low. Shanghai Futures Exchange, lowest since 2015. London lease rates elevated. Classic shortage indicator. COMEX warehouse stocks, multi-year lows. Why deficits? Industrial demand. Silver, most electrically conductive metal, most thermally conductive, most reflective. Unique properties make it irreplaceable. Solar, every panel uses 20 grams. Solar industry consumed nearly 300 million ounces in 2025, 30% of global demand. Despite efficiency improvements reducing silver per panel, total consumption grows. EU target, 700 gigawatts by 2030. China building unprecedented scale. US has Inflation Reduction Act incentives. Electric vehicles, 25 to 50 grams per EV in contacts, switches, batteries. Steady demand growth as EV sales expand. Game changer, artificial intelligence. AI data centers represent the most silver-intensive computing infrastructure ever constructed in human history. The servers that run large language models, the networking equipment that connects distributed computing clusters, the massive power distribution systems that deliver electricity, all of these components require silver for their electrical connections and thermal management systems. And here's the crucial technical detail that most analysts overlook. AI-optimized servers consume 2 to 3 times more silver than traditional data center equipment because of their more complex architectures and higher power densities. As the AI revolution accelerates from research labs into mainstream deployment across every industry imaginable, technology companies are constructing massive new data centers to support large language models, generative AI applications, autonomous vehicle processing, and countless other machine learning workloads. The scale is staggering. Microsoft alone has announced plans for multiple billion-dollar AI data center projects. Google, Amazon Web Services, Meta, all are building or massively expanding AI-specific infrastructure. The AI power demand trajectory is almost vertical. Industry projections show global AI-related power consumption doubling by the end of 2026, and every single kilowatt of that power requires silver-intensive infrastructure to generate, transmit, distribute, and ultimately deliver to the computing equipment. And unlike solar panels, which eventually get decommissioned and potentially recycled after their 25 or 30-year operational lifespan, the silver embedded in AI hardware is essentially consumed permanently. It's locked into microscopic electrical connections, soldered joints, and thermal interface materials that are not economically or practically recoverable at end of life. When an AI server is retired, the silver goes to electronic waste, not back into the supply chain. Inelastic demand. Industrial users can't stop buying when price rises. If data center costs $10 billion and silver component $50 million, you don't cancel entire project. You pay market price. Different from price-elastic jewelry demand. When gold spiked, Indian jewelry dropped. When silver spikes, solar and AI keep buying. Supply problem, 70% of silver is byproduct of copper, lead, zinc mining. Even at $150 or $200, miners can't just produce more. They need to mine more copper first. Structural supply rigidity. New mines take 5 to 10 years. No quick price response. 2025 mine supply, flat at 813 million ounces. 2026 forecast, similar. No major new mines. Recycling adds 180 to 190 million ounces yearly, not increasing fast enough to offset deficits. China factor, early 2026, China tightened refined silver export restrictions. World's largest producer and major refiner removing supply from global market. Why? Need domestic silver for massive solar build-out. Strategic metal classification. Geopolitical leverage through critical material control. Inelastic demand, structural deficits, geopolitical export controls create what commodities traders call a squeeze. JP Morgan on silver, more cautious than gold. Without central banks as structural dip buyers, risk exists for higher gold to silver ratio. Translation: silver more volatile, crash proved it, but they still see higher average price floor around $75 to $80 than previously expected. 75 to 80 floor. After crash from 121 to 71, JP Morgan says new normal floor exceeds old peaks. Industrial demand driving permanent silver repricing. Even post-crash, fundamental imbalance unchanged. The divergence established, retail sold, institutions bought. What should you do? First, what this is not a signal to go all in tomorrow. Not leverage up on futures. Definitely not financial advice. Consult qualified professionals. What this is: smartest money in the world, trillion-dollar institutions with PhD economist teams, taking very different view than panicked retail. Institutional Playbook 2026. Gold and silver as portfolio insurance, not speculation. Allocation typically 5 to 10% of diversified portfolio, not 50, not 80. Measured, strategic. Think years, not months. JP Morgan's 6,300 target, end of 2026, 11 months away. Not trading every 10% move. Positioning for year ahead, 5 years ahead. Focus on long-tail fundamental drivers. Central bank buying won't stop next quarter. Silver deficits won't resolve in 6 months. AI build-out takes decades. Structural trends, not cyclical. Use volatility as opportunity. Retail panics during crashes. Institutions see better entry prices. Warren Buffett, fearful when others greedy, greedy when others fearful. Specific factors, institutional analysts watch rest of 2026. Federal Reserve policy. Warsh matters but isn't everything. Fed caught in trap. 38 trillion debt, interest approaching 1 trillion annually, eventually forced to cut, preventing debt spiral. When pivot comes, precious metals benefit. Central bank gold buying pace. If China, Russia, Saudi Arabia ramp purchases, strong, bullish signal. If pause or reverse, bearish. US dollar. Gold and silver priced in dollars globally. Weaker dollar makes metals cheaper for foreign buyers, boosts prices. Dollar strong recently, many expect weakening later in 2026 as Fed cuts. Geopolitical stress. Major events, conflict, sanctions, trade wars, gold benefits as safe haven. Current environment highly unstable, structurally supportive. Industrial demand indicators for silver, solar installations, EV sales, AI data center construction data. Strong sector growth means robust industrial demand regardless of investment flows. Physical market tightness. Watch warehouse inventories, lease rates, physical premiums over paper prices. Spiking physical premiums signal shortage, often precede major moves. Elephant in room. What if institutions wrong? Absolutely possible. JP Morgan made bad calls before, no perfect track records, future uncertain, scenarios where metals fall from current levels exist, bear scenarios, Warsh Fed crushes inflation without recession, real rates stay high, dollar strengthens dramatically, rotation to bonds, gold toward 4,000, silver toward 50, industrial silver demand collapses faster than expected, AI bubble, solar plateau, substitution technologies, industrial thesis breaks, silver particularly vulnerable. China floods market with unreported inventory. Sudden stockpile release temporarily overwhelms demand, crashes prices. Genuine debt crisis solution emerges. Governments manage debt without printing or defaulting. Fear premium in gold evaporates. Worth understanding bear cases. Professionals think scenarios and probabilities, not certainties. Notable, even JP Morgan's bear case has gold well above 2 years ago. Framework assumes permanent repricing. Regime change where old ranges don't apply. Individual investor lessons from divergence. Don't panic sell during crashes just because price falls. Ask, has fundamental thesis changed? If you bought gold as monetary debasement insurance, did crash change that? Institutional response suggests thesis strengthening. Avoid excessive leverage. Wiped out retail used leveraged ETFs or futures. Institutions building long positions use minimal or no leverage. Leverage turns volatility from uncomfortable to catastrophic. Think institutionally, not trader-like. What's your time horizon? Allocation strategy? What changes your thesis? Write these down before investing. Framework for volatility. Diversification matters. No single investment, gold, silver, stocks, real estate, should be entire portfolio. Bullish institutions still hold stocks, bonds, real estate, alternatives. Metals are one component. Understand paper versus physical difference. Key silver theme is paper, futures ETFs, versus physical, coins, bars, divergence. During crash, physical premiums spiked while paper fell. Real imbalance in physical market. Long-term holders might prefer physical over paper claims. Institutional view summarized. Late January crash was violent correction within ongoing secular bull. Fundamental drivers, central bank buying, currency debasement, geopolitical fragmentation, industrial silver demand. Intact, arguably strengthened. Retail sold emotionally to short-term volatility. Institutions positioned for long-term structural trends. History suggests in these divergences, institutional view tends right more often. Let's synthesize. Late January 2026, historic precious metals crash. Gold down nearly 10% single day. Silver collapsed over 30%, most violent correction in 4 decades. Retail panicked. ETF outflows surged. Social media declared bull market dead. 72 hours later, JP Morgan raised gold target to 6,300. Deutsche Bank maintained 6,000. Goldman Sachs stood by 5,400. Retail selling in fear. Institutions positioning to buy. Why divergence? Institutions focused on fundamentals retail overlooks. Central banks buying 800 tons yearly, 1/4 mine production. Structural multi-year trend from geopolitical realignment, de-dollarization. Silver 5th consecutive deficit year. Cumulative 820 million ounce shortfall. Industrial demand from solar, EVs, AI infrastructure price inelastic and growing. Global monetary system regime change. Old assumptions, low inflation, stable currencies, predictable central banks, gone. Gold's role as nobody's liability, increasingly valuable. Interest rates structurally biased toward eventual cuts due to unsustainable debt. When pivot comes, metals benefit. Crash from institutional perspective, volatility event, not thesis break. Margin calls, forced liquidation, algorithmic selling, not fundamental supply-demand change. Individual investor key takeaway, not blindly follow JP Morgan forecast. Understand difference between institutional thinking and retail emotion. Institutions think decades and fundamentals. Retail thinks days and price charts. Institutions use crashes as adding opportunities. Retail uses crashes as panic triggers. Institutions allocate on strategic themes. Retail allocates on momentum and fear. Gap between approaches is where wealth transfers happen, where generational wealth builds through emotion control and structural thinking, where capital destroys through emotional short-term reaction. Moving through 2026, institutional precious metals playbook clear, measured allocation, long horizon, fundamental focus, volatility as opportunity. Historical retail playbook, chase momentum up, panic sell down, repeat. Which playbook you follow likely determines results. Will gold really hit 6,300 year-end? Silver recover to 100 plus? Nobody knows certainly. Markets are complex adaptive systems. Surprises happen. But we know, when world's largest, most sophisticated institutions buy what retail dumps, pay attention. When central banks from Poland to China to Kazakhstan accumulate monthly, even at records, that's signal. When industrial silver demand outstrips mine supply fifth consecutive year, that's structural imbalance not quickly resolved. When global monetary system fundamental architecture shifts real time, from dollar dominance toward multipolarity, from fiat trust to hard asset demand, that's regime change. These factors institutional investors analyze. These trends they position for. These reasons they raised gold targets days after worst crash in 40 years. Question isn't whether you should own precious metals. That's personal based on situation, goals, risk tolerance. Question is, when making investment decisions, are you thinking like institutions building generational wealth or reacting like retail historically underperforming? Great Divergence of February 2026 offers masterclass in market psychology. Retail panicked, institutions positioned. If history guides, institutions proven right. Not because smarter, but because they have discipline, time horizon, framework to withstand volatility, and focus fundamentals. That's real lesson, not specific price targets, not technical analysis. The mindset. In investing as in life, long-term thinkers tend to win. Emotional reactors tend to lose. 2026 crash was test. Retail failed. Institutions passed. Which side of that divide you want to be on is up to you. Thanks for watching. Subscribe for more deep market dives. Remember, do your own research, understand risk tolerance, never invest money you can't afford to lose. The game is long, play it that way.